All right, reading 42, risk management and introduction. Learning outcomes. The candidate should be able to define risk management, describe features of risk management frameworks, describe risk governance, and describe elements of effective risk governance. Explain how risk tolerance affects risk management. Describe risk budgeting and its role in risk governance. Identify financial and non-financial risks, and describe how they may be interact. Describe methods of measuring and modifying risk exposures and factors to consider in choosing among these methods. Introduction. Risk and risk management is an inescapable part of economic activity. People generally manage their affairs in order to be happy and secure as their environment and resources will allow. But regardless of how carefully these affairs are managed, there is a risk because the outcomes, whether good or bad, is seldom predictable with complete certainty. There is risk inherent in nearly everything we do. But this reading will focus on economic and financial risk, particularly as it relates to investment management. All businesses and investors manage risk, whether consciously or not, in the choice they make. At its core, businesses and investing are about allocating resources and capital to chosen risks. In their decision, portfolio managers need to be familiar with risk management, not only to improve the portfolio's risk-return outcome, but also because of two other ways in which they use risk management at an enterprise level. First, they help to manage their own companies that have their own enterprise risk issues. Second, many portfolio assets are claims on companies that have risk. Portfolio managers need to evaluate the company's risk and how these companies are addressing them. This reading takes a broad approach that addresses both the risk management and enterprises are generally and in general in portfolio risk management. The principles underlying portfolio risk management are generally applicable to the risk management of financial and non-financial institutions as well. The concept of risk management is also relevant to individuals. Although many large entities formally practice risk management, most individuals practice it more informally, and some practice it haphazardly. Oftentimes, responding to risk events after they occur, although many individuals do take responsible precautions against unwanted risk. These precautions are often against obvious risks, such as a sinking wet hand into an electrical socket or swallowing poison. Who wrote this, man? Okay, the more subtle risks are often ignored. Many individuals simply do not view risk management as a formal, systematic process that would help them achieve not only their financial goals, but also ultimate end result of happiness. Seriously, who wrote this? This is so cheesy. A maximal utility, as economists like to call, but they should. Although the primary focus of this reading is on institutions, we will also cover risk management as it applies to individuals. We will show that many common themes underlie risk management, themes that are applicable to both organizations and individuals. Although often viewed as defensive, risk management is a valuable offensive weapon in the manager's arsenal. In the quest for preferred outcomes, such as higher profit returns or share prices, management does not usually go to choose the outcomes, but does choose the risk it takes in pursuit of those outcomes. The choice of which risk to undertake through the allocation of its resources, scarce resources, is the key tool available to management. An organization with a comprehensive risk management culture in place is which risk is integral to every key strategy and decision should perform better in the long run. In good terms than bad, as a result of better decision making. The fact that all business and investors engage in risky activities raises a number of important questions. The questions that this reading will address includes the following: what is risk management and why is it important? What risk does an organization face in pursuing its objectives? How are an entity's goals affected by risk, and how does the market risk management decisions to produce better results? How does risk governance guide the risk management process and risk budgeting? to integrate the organization's goals with its activities. How does an organization measure and evaluate risk it faces, and what tools does it have to address these risks? The answers of these questions collectively help to define a process of risk management. Its readings are organized along the lines of these questions. Section 2 describes the risk management process. Section 3 describes risk governance and risk tolerance. Section 4 covers the identification of various risks, and Section 5 addresses the measurement and management of risk. Section 6 provides a summary. Risk management process. Risk, broadly speaking, is exposure to uncertainty. Risk is also the concept used to describe all of the uncertain environmental variables that lead to variation in the unpredictability of outcomes. More colloquially, risk is about the chance of a loss or adverse outcomes as the result of an action, inaction, or external event. The last view may make it sound as if risk is something to be avoided, but that is not at all the case. Risk is a key ingredient in a recipe of business or investment success. The return without risk is great as generally a false hope and usually a presumption of falling short of one's goals. Risk taken must be carefully chosen, understood, and well managed to have a chance in adding value through decisions. Risk and return are the interconnected forces of the financial universe. Many decision makers focus on return, which is not something that is usually controlled, as opposed to risk or exposure to risk, many which may actually be managed or controlled. Risk exposure is the extent to which the underlying environmental or market risk results in the actual risk borne in the business or investor who has the asset or liability that are sensitive to those risks. In a state of being exposed to valuable to the risk. Risk exposure results from a decision of an organization or investor to take on risk-sensitive assets and liabilities. Suppose that there is an important announcement in Japan that will result in the yen either appreciating or depreciating by 1%. The range of possible outcomes is the real situations is clearly not as simple as the up and down of 1% case used here, but we will use a simplified example to make an important point. The risk is the uncertain outcome of the event, and the currency risk of a non-Japanese business, and the uncertain return of valuation and return in domestic currency returns that result from the event. The risk can be described as a range of the resulting outcomes, and is often dot in terms of the probability distribution of future returns. Suppose that that the underlying amount is a million yen. The risk exposure of a business may be 0, or it can be sizable depending on whether the business has assets or liabilities tied in the risk. In this case, exposure to the currency, 1 million yen, would, in this example, result in a 10,000 yen of risk exposure. Risk management will include, among other things, quantifying and understanding the risk exposure, deciding how and why to have the exposure and how much risk the participants can bear, and possibly mitigating this risk by tailoring the exposure in a number of ways. The risk management process will inform the decision of whether to operate or invest in this risky currency. Risk management is so that's the definition. Said differently, risk management is the process by which an organization or individual defines the level of risk to be taken, measures the level of risk being taken, and adjusts to the latter towards the former, with the goal of maximizing the company's or portfolio's value or the individual's overall satisfaction or utility. I'm drinking plain water today. It's kind of a culture in this tradition, culture and tradition of this channel to talk about what I'm drinking. Okay, so here's examples of risk. A risk management framework flows logically from the definition of risk management with the previously given. It is an infrastructure, process, and analytics needed to support effective risk management in an organization. This process should fully integrate the risk and return aspects of the enterprise into decisions in support of best achieving its goals with its tolerance for risk. Risk management is not a one-size-fits-all solution. It is integral to the enterprise's goals and needs. Thus, it is best achieved through a custom solution. Despite customization, every risk management system or framework should address the following key factors: risk governance, risk identification and measurement, risk infrastructure, defined policies and processes, risk monitoring, mitigation and management, communication, strategic analysis, or integration. Not surprisingly, these factors often overlap in practice. They are defined and discussed here. Governance is the top-level system of structure, rights, and obligations by which organizations are directed and controlled. Normally performed at the broad level, governance is how goals are defined, authority is granted, and top-level decisions are made. The foundation of risk management in the organization is set at the broad level as well. Risk governance is the top-down process and guidance that directs risk management activities to align with and support overall enterprise, and is addressed in more detail in section 3. Good governance should include defining an organization's risk tolerance and providing risk oversight. Governance is often driven by regulatory concerns, as well as being as the fiduciary role of the governing body. A risk management committee is another facet of the governance. It provides top decision makers with a forum organization. Risk governance should take an enterprise-wide view. Enterprise risk management is an overachieving governance approach applied throughout the entity and consistent with the strategy, guiding the risk management framework to focus risk activities on the objectives, health, and value of the entire organization. Risk identification and measurement is the main quantitative core of risk management, but more than that, it must include the qualitative assessments and evaluation of all potential sources of risk and organization's risk exposure. This ongoing work involves analyzing the environment for relevant risk drivers, which is the common term used for any fundamental underlying factor that results in a risk that is relevant or important to an entity. Analyzing the business or portfolio is to ascertain risk exposures, tracking changes in these risk exposures, and calculating risk matrices to size these risks under various scenarios and stresses. Risks are not limited to what is going on in the financial market. There are many types of risk that could potentially impact a business, portfolio, or individual. A fuller overview of the range of risk will be the focus of Section 4. The power of technology has allowed for risk management to be more quantitative. Timely management can measure and monitor risk, run scenarios, conduct statistical analysis, work with more complex models, and examine more dimensions and risk drivers, as well as do it faster. The use of technology needs to be balanced with the supplement, not supplant experienced business judgment. Technology has made risk infrastructure even more important and beneficial in managing risk. Risk infrastructure refers to people and systems required to track risk exposures and perform most of the quantitative risk analysis to allow an assessment of the organization's risk profile. Infrastructure would include risk captures, database and data model, analytical models and systems, a stress or scenario engine, and an ability to generate reports, as well as some amounts of skills and empowered personnel resources dedicated to building and executing the risk framework. With increased reliance on technology, more time and effort must be allotted to test data, models, and results in order to avoid the ironic outcome of risks of errors coming from within risk systems. Obviously, the scope of risk infrastructure will be related to the resources or potential losses of the organization. Individuals and smaller businesses may rely heavily on external partners to provide much of their risk governance in both day-to-day operations and precision-making processes of the organization. They may be limits, requirements, constraints, and guidelines, some quantitative, some procedural, and to ensure risky activities are in line with the organization's predetermined risk tolerance and regulatory requirements. Much of this is just common sense business practice, updating the updating and protecting data, controlling cash flows, conducting due diligence on investments, handling expectations and escalations, and making checklists to support important decisions. In a good risk framework, processes would naturally evolve to consider risk at all key decision points, such as investment decisions on asset allocation. Risk management should become an integrated part of the business and not just a policing or regulatory function. The process of risk monitoring, mitigation, and management is the most obvious facet of risk management, but also one of the most difficult. Actively monitoring and managing risk requires pulling together risk governance, identification, and measurement infrastructure and policies and processes, and continually renewing re-evaluating the faces of changing risk exposures and risk drivers. It requires reorganization when risk exposures is not aligned with risk tolerance, and then taking action to bring them back into alignment. Communication to critical risk must happen continually and across all levels of the organization. Governance parameters, such as risk tolerance and associated constraints, must be clearly communicated to and understood by managers. Risk matrices must be reported in a clear and timely manner. Risk issues may be rewarded and discussed as a standard point of decision-making. Changes in exposure must be discussed so that actions can be taken as appropriate. There should also be a feedback loop with the governance body so that the top-level risk guidance can be validated or updated and communicated back to the rest of the organization. Strategic analysis and integration help turns risk management into an offensive weapon to improve performance. Good risk management is a key to increasing the value of overall businesses or portfolios. A risk management framework should provide the tools to better understand the hows and whys of performance and help sort out which activities and adding value and which are not. In investing, rigorous analysis can support better investment decisions and improve strategies and risk-adjusted returns. Here's a diagram. Exhibit 1 illustrates the process of risk management for an enterprise, pulling all the described elements of the risk framework together. Although there is a very high number of risks faced by every organization, most organizations are primarily affected by small numbers of key risk drivers or primary underlying factors that create risk. Along with far left sides of risk governance, which presents broad levels of decisions and encompasses and affects the boxes and immediately to its right. The governance body often calls a board defines the goals of the organization and in turn decides on its risk tolerance, and it may additionally provide guidance on how or where the risk is taken or risk budgeting. The board is also involved in settling high-level policies and will affect most risk management processes. Those risk governance activities are a crucial keystone of the risk framework and will be discussed in detail in the next section. When the rest of the risk framework hinges off these top-down governance elements and the focus of the goal of the entire enterprise as shown here, the end result is effective risk management. The role of management shown in the middle column is to plan and execute value maximizing strategies consistent with the governance guidance. Each management activity is a framework flow, not only for measurement shown with the arrows, but also of governance activities on the left. Thus, not only are management's strategies designed to achieve the board's goals, but management also allocates capital to risky activities to execute its strategies consistent with the defined risk tolerance. The risk exposure that results from management's choice of active activities should be aligned with the governing body's risk budget. In addition, management participants actively is setting or implementing policies and establishing procedures that relates to when, how, and how much, and by whom each of the other elements of risk frameworks are performed. The rest of risk management frameworks comprises a number of important risk activities to help the business achieve all of its strategic and governance goals and mandates. These other elements to implement risk management are shown in the far right column of the illustration, driven by its needs to establish a risk management program to support an enterprise's goals. Management would provide the requisite resources for risk management activities by establishing a risk management infrastructure. When risk processes defined the risk infrastructure in place, risks are then identified and measured, which is a regular and continual process of translating risk exposures into meaningful and generally quantitative risk matrices. The next major step, risk monitoring, mitigation, and management, are where much of the firm's day-to-day risk management activities is focused. These activities are split across 3 boxes on the illustration. Risk levels are continually monitored, having just been measured. There is a major decision at the monitoring stage. Management must check that all the risks are in line with and not outside of the limits of the defined risk tolerance or budget. The process involves evaluating the actual risk exposure compared with the organization's risk policies and procedures to ensure that everything is in compliance. If the answer is no, the risk mitigation and management actions need to be taken to modify risk levels and to bring them back into compliance. There are a variety of methods to accomplish these tasks. When risks are in line with limits, policies, tolerance, mandates, and so on, then the process moves back to continuous monitoring, followed by communicating risk levels. This communication, at a minimum, includes reporting key risk metrics on a regular and timely basis across the organization to assist management in its decision-making process and the board in fulfilling its governance duties. Finally, strategic analysis is supported by the risk measurement, reporting, and other steps of the enterprise risk management process by analyzing all the enterprise's strategies and risk activities through the risk measurement lens. Management can improve its decision-making process and ascertain where to invest its limited capital and risk budget most fruitfully. This step is generally underappreciated and is an inexpensive and beneficial byproduct of having built a risk framework. The last 2 boxes or steps represent important feedback loops to inform and improve both governance and the portfolio of risky activities that make up the business. There are many feedback loops in properly executed risk management in practice. Most of these steps overlap most of the time and are being performed simultaneously. Good risk management ties together all these steps from a highest governance decision to lowest level specifics, each as a model, report, and operational checklist. The risk environment is dynamic, and many of our notions of prohibition, probabilities, and likely risk outcomes changes in ways we probably would not predict. The risk management framework should be robust enough to anticipate this dynamism, to expect the unexpected. It should be evolutionary, flexible enough to grow with a company or individual. in its new challenges. The complexity of a risk management framework depends on the complexity of the entity's risk exposure and the resources. But that does not mean that smaller organizations or individuals should skip the risk management process. They may simply be able to do less or have to work with external parties to assist with large portions of the framework, or be less formal about the process. Ultimately, the key principles just covered are still important, even if even to the smallest entity, even if the specific components do not get assembled as described. Here's an example. Risk management process for an individual. At its core, businesses businesses and investing are about allocating resources and capital to chosen risks. Understanding which risks are drives better outcomes should be one of the goals of risk management, and it makes good risk management extractably linked with good management generally. When effective risk management is truly integrated at all levels of the decision-making process and the overall management process, the organization has developed an effective risk culture. The risk generally produces better results than just combining risk issues as a separate afterthought, and in turn produces much better results than ignoring risk issues altogether in the decision-making process. For individuals, the adaptation of a risk culture should result in a personal awareness of the many types of risk, their rewards, their costs, their relationship between them, and the method of aligning the risk borne with the risk and the outcomes desired. The awareness should lead to better investment returns and or smaller losses for the risk taken, resulting in higher satisfaction. There are a number of other benefits from establishing good risk management. Most obvious is less frequent surprises and a better notion of what the damage would be in the event of a surprise. More decision disciplines leading to better considerations of trade-offs and better risk-return relationships. Better response and risk mitigation stemming from more awareness and active monitoring, which should policies and procedures, transparencies, and risks. Better relations with more trust between the governing body and management, which generally results in more effective delegation. A better image or a reputation because analysts and investors perceive a company as prudent and value-focused together. All these benefits should lead to higher values for the enterprise. Risk governance. Risk governance is the foundation of risk management, as defined earlier. It is the top-down process and guidance that directs risk management activities to align with the support of goals of the overall enterprise. It typically emanates from a board of directors with a fiduciary regulation or obligation and a risk oversight, and who prescribes goals and authorities, referring back to the definition of risk management. Note that risk management is keenly focused on the risk and value of the overall enterprise. Enterprise views of risk governance. In addition to the responsibilities of risk oversight, there are two other important areas in which the governing body drives the risk framework. First, it determines the organization's goals, directions, and priorities, which combined serve as a key foundation of enterprise risk management. Recall that enterprise risk management is an overachieving governance approach applied across the entity that focuses risk activities on the objectives, health, and value of those of the whole organization. Second, it spills out the risk appetite or tolerance, meaning which risks are acceptable, which risks are to be mitigated, and to what extent, and which risks are acceptable. Risk governance should be also provided a sense of worst losses and could be tolerated in various scenarios. The management should manage risk accordingly. These considerations should flow naturally into decisions about risk budgeting to guide implementation of the optimal program, and this consistent with the risk tolerance. Risk governance is the impact of governing body of organization under risk management frameworks. It provides context for the clarity on an organization's value drivers and risk appetite, specifies clear authority to management to execute risk management and ensure risk oversight to continually determine whether risk management is functioning well and consistent with the organization's values. Maximization in the governing body's job to tie the organization group goals and risk framework together. Thus, risk governance happens within an enterprise context. Risk governance and risk oversight also entails compliance with regulatory requirements. Risk governance is a difficult and demanding discipline, and if it is going to flourish in an organization, it needs visible commitment from the top. Providing clear guidance with if a sufficient leeway to execute strategy is often a difficult balance. Even more challenging is providing for evidence discussion and a clear discussion about the risk appetite after a crisis, but often there is very little discussion during periods of normalcy, when it would be much more beneficial, because risk is one of the main strategic tools that management can regulate. It is especially important of government bodies to openly discuss risk, consider scenarios, understand the impact of negative outcomes on the organization, and make it clear that they are not willing to venture. More like the automobile that came of the red zone, and likewise establish hypothetical red zones to ensure the safe operations of their enterprise value of a whole organization. Requires that the entire economic balance sheet of a narrow view of risk management is likely to meet the goal of maximizing the value of entire enterprise. Pension funds management provides classic examples of important considering enterprise risk management. Funds are the assets and pensions are the liabilities. Fund managers. Okay, so here's just an example of pension funds. Okay. Nothing too important here. Risk tolerance. Perhaps the most important element of good risk governance is risk tolerance. Discussion and decision within the government body, business and investment strategy centers on selecting a portfolio of acceptable risk activities that will maximize value and produce the highest return possible for the given risk level. At the governance level, the duty is general, but not to select these activities. A joke that usually falls to management, but to establish your organization's risk appetite, certain risks or levels of risk must be deemed acceptable, other risks deemed unacceptable, and in the middle are risks that may be pursued in a risk-limited fashion. Said it differently, risk tolerance identifies the extent to which entities is willing to experience losses or opportunity costs and to fail in meeting its objectives. The enterprise risk management perspective is the right lens through which a view with the risk appetite question. This risk appetite decision begins with two different analyses of that must be integrated, an inside view and an outside view. First, what shortfalls within an organization will cause it to fall, or at least fail to achieve some critical goals. Second, what uncertain forces in the organization exposed is the organization exposed to. This is broad. It could be being defining demonstration, the level of risk and that is find to be uncomfortable crisis, and will soon serve the high level guidance of crisis, which is better after the loss. For example, suppose a Spanish construction equipment manufacturing company's board is determining the risk tolerance. From the inside perspective, it has two main revenues, but it's down 20% would trigger the debt covenants and put the launch of its new flagship product at risk. related to the strategy needs 40 million of cash flows, none of the cash flows at risk. From the outside perspective, it realizes that there are three main uncertainties of risk drivers over which it has no control. Control in the equities, both its business results and its owner's stock price are strongly correlated with these three risks and combined by adversely affecting them, any of them. Risk budgeting. Risk budgeting picks up where risk tolerance leaves off, whereas risk tolerance focuses on the appetite for risk and which is not acceptable. Risk budgeting has a more specific focus on how that risk is taken. Risk budgeting quantifies the allocates the tolerable risks by specific matrices. It extends and guides implementation of their risk tolerance decision. Risk budgeting applies to both business management and portfolio management. Its foundations is the perspective that businesses or portfolios management involves assembling a number of risk activities for securities, which can be called into assemblage of that is allocated 20% to hedge funds, 30% to private equity, and the remaining 50% between stocks and bonds. An alternative risk view of the same portfolio might be 70% driven by global equity returns, 20% by domestic equity returns, with its remaining 10% driven by interest rates. The equity component might be allocated 65% to value of 35% to growth. The portfolio might also have 45% liquid securities, inflation, long-term interest rates, currencies, and so on. Risk budgeting is any means of allocating a portfolio based on the sum of its risk characteristics in an investment. Okay. Okay, summary. Success in business and investing requires the skillful selection and management of risk. Well-developed risk management process ties together an entity's goals, strategic competencies, and tools to create value to help it both drive and survive. Good risk management results in better decision-making and a keener assessment of the many important trade-offs in business and investing, helping managers to maximize value. Risk management are critical to good businesses and investing. Risk management is not only about avoiding risk. Taking risk is an active choice by boards and managers. Investment managers and individuals. Risk must be understood and carefully chosen and managed. Risk exposures is the extent to which an entity's value may be affected through sensitivity and underlying risk. Risk management is the process that defines risk tolerance and measures, monitors, and modifies risks to be in line with the tolerance. A risk management framework is the infrastructure, process, and analytics needed to support effective risk management, to include risk governance, risk identification and measurement, risk infrastructure, risk policies and processes, risk mitigation and management, communication and strategic risk analysis and integration. Risk governance is the top-level foundation of risk management, including risk oversight and setting risk tolerance for the organization. Risk identification and measurement is the quantitative and qualitative assessment of all potential sources of risk and the organization's risk exposure. Risk infrastructure comprises the resources and systems required to track the axis of organization's risk profile. Risk policies and processes are management's complement to risk governance at the operating level. Risk mitigation and management is the active monitoring and adjusting of risk exposures, integrating all the other factors of risk management frameworks. Communication includes risk reporting and active feedback loops so that the risk process improves decision making. Strategic risk analysis and integration involves using those risk tools to rigorously sort out the factors that are and are not adding value, as well as incorporating this analysis into management decision process with the intent of improving outcomes. Employing a risk management committee along with a chief risk officer, the CRO, and a hallmark of strong risk governance frameworks. Governance is the entire risk process should take an enterprise risk management perspective to ensure that the value of the entire enterprise is maximized. Risk tolerance, a key element of good risk governance, delineated with risk and acceptable, with the unacceptable, and how much risk the overall organization can be expected to. Risk budgeting is any means of allocating investment or assets by their risk characteristics. Financial risks are those that arise from activities in the financial markets. Non-financial risks arise from actions within the entity or from external origins, such as the environment, the community, regulators, politicians, suppliers, and customers. Financial risk consists of market risk, credit risk, and liquidity risk. Market risk arises from movements in stock prices, interest rates, exchange rates, and commodity prices. Credit risk is the risk that the counterparty will not pay an amount owed. Liquidity risks is the risk that, as a result of degradation in market conditions or the lack of market participants, one will be unable to sell an asset without lowering the price or to less than the fundamental value. Non-financial risk consists of a variety of risk, including settlement risk, operational risk, legal risk, regulatory risk, accounting risk, tax risk, model risk, tail risk, and sovereign to political risk. Operational risk is the risk that arises when the operation of the organization includes both human and systematic or systems or process errors. Solvency risk is the risk that the entity does not survive or succeed because it runs out of cash to meet its financial obligations. The individual faces many of the same organizational risk outlined here, but also faces health risk, mortality or longevity risk, and property and casualty risk. Risks are not necessarily independent because many risk arises as a result of other risk. Risk intolerance can be extremely non-linear and harmful. Risk drivers are the fundamental global and domestic macroeconomic and industry factors that create risk. Common measures of risk include standard deviation or volatility, asset-specific measures such as beta or duration, derivative measures such as delta, gamma, vega, and rho, and tail measures such as value at risk, CVR, and expected loss. Given default, risk can be modified by preventing and avoiding an avoidance, risk transfer, and insurance, or risk shifting or derivatives. Risk can be mitigated internally through self-insurance and diversification. The primary determinants of which method is best for modifying risk are the benefit weighting against the cost, with considerations of overall final risk profile and adherence to risk governance objectives. This is reading. This is the reading 42. I do hope my readings have been helpful. The show notes are in the description below. Go to Amazon, get the show notes, and I hope to see you guys in the next section where we'll be reading 43. Goodbye.